And we're back. Welcome back to Retirement Decoded, the podcast. I'm your host, Scott Tucker. With me, as most of the time, is my trusty sidekick, associate advisor, Matt Marabella. Say hello, Matt Marabella.
Hello, Matt Marabella.
And we've got the robot cameras. If you haven't seen the video version of the podcast, oh boy, you're missing out. It's at tuckeryoutube.com. It's at tuckeryoutube.com. If you're listening to the podcast in audio form, down below in the description, it'll say see the podcast. I don't know, something like see the video podcast at tuckeryoutube.com. If you're on YouTube, it won't say that because you're already here. So tuckeryoutube.com. We drop a new podcast episode every Monday morning at 0500 hours Central Time. We are in Chicago. However, we're federally licensed. We can help Americans all across the fruited plain, all 50 states, District of Confusion, and United States territories. So Guam to, I think St. Thomas would be the eastern one. How far east can we go with this as far as territories? I think St. Tom or St. John. Anyhow, there was an article, and now this is going to be dated because it's been in the stack of stuff for some time. But there was an article in the business and finance section of the Wall Street Journal, sort of like section B, I guess, if you're talking about like a regular paper. And there's a gentleman that writes for the Wall Street Journal. His name is James McIntosh, and we've been talking a lot, Matt. We've been warning about what we see might be a bubble in the U.S. stock market, and maybe in international markets even because of this AI thing.
Yeah, we've seen sometimes the international markets have been rough.
Well, there's a lot of I don't know if I ever trust the Chinese markets, and the Korean markets are a little weird. There's a lot of AI froth in a lot of places. I think the U.S. stock market seems to be the frothiest though, and the one that we're most concerned about. But James McIntosh wrote some time back for the Wall Street Journal, and this is another sign of a bubble. And I wanted to bring it to your attention as maybe this irrational exuberance about these AI stocks. So the headline says bubble sign : one stock, two prices, two places. So Matt, one stock that has two different prices in two different places. So there's a company. This company makes memory chips, and this chip maker is a South Korean company. So the name of the company is SK, like South Korea, SK Hynix. So SK Hynix, it's a chip maker that make memory chips. Now this has AI implications, right? There's a big AI hysteria or whatever it is out there. And Matt, we talked about this the other day. A lot of folks don't realize if a company is traded on, say, the South Korean stock market, Japanese stock market, Chinese stock market, we Americans, the easiest way for, I know you know this, I'm just preaching to the choir, Americans, the easiest way to own a stock that's traded on a foreign exchange is how, Matt?
It would be an ADR. That's an American Depository Receipt.
Right. So if you want to own, if you're an American in America, and this SK Hynix, I believe, is traded on the South Korean market. It doesn't actually say, and I never looked that up. But, price in Korea, right? So if you want to own a share of SK Hynix, you could. It's a little bit more of a backflip deal, and there might be some investable asset minimums to be able to pull this off. You could get with somebody to buy, like we could do this for you if you're of means. Now it'd have to be a special amount of investable assets for us to fuss with it, but we certainly could do it. And if it's important to you, we would do it. Even you don't have to be Warren Buffett or anything, but we would arrange for it. But it's a little bit of a backflip for us. You could buy shares of the SK Hynix stock on the Korean exchange and avoid the whole American depository receipt. But most Americans are going to fall into the easy button, and they're going to buy the American depository receipts on the NASDAQ, in this case, for the SK Hynix stock. And so, Matt, we talked about this. We had a morning meeting some time back, and we talked about this story then, and we saved the story for the podcast. But what's happening right now is there's a dislocation. So, Matt, of course, when bubbles form, there's a dislocation between stock price and the fundamentals, the underlying fundamentals.
That's correct.
Right. So Americans are, I think Americans are more gung-ho about AI than just about anybody. I mean, that's kind of being a thing.
I would definitely say so.
It sure feels like it. So this SK Hynix stock, if you buy it on the Korean exchange, I don't have the stock price in front of me, but let's say it's $100. Well, the American depository receipts are dislocated from that stock in the South Korean exchange between 16 and 51% premium. So let's say if the stock is $100 a share, Americans are paying anywhere from $116 to $151 per share because they're buying them on the NASDAQ as American depository receipts or ADRs. And so they're not doing their homework, Matt. Are you shocked?
A little bit. You're willing to pay an extra $50 per share?
Yeah, extra 51%. What a bargain.
Wow.
You could almost...
Usually you buy at a discount.
Well, it's like I could see if maybe it was 1%, even that's sloppy. But I don't know how this is happening exactly. I'm not a big like Jim Cramer fan or something. Are folks watching Jim Cramer and this running out and say, "Oh, SK Hynix, buy," and do ADRs?
Maybe it's the same people who are telling our other folks to go out and buy NVIDIA and SpaceX and all that.
Oh yeah. So this is just another case where you got to check your references. Of course, Matt, we teach what John Bogle would teach is that specific stock risk. And one of our favorite sayings is, Matt, unnecessary risk is...
unnecessary.
Exactly. So let's not chase the hot stock. You can really get hurt doing that. If you were really cuckoos for Cocoa Puffs, maybe you could do that with one stock, maybe up to about 4 or 5% of your total holdings. That's not even smart. And some people are less smart than that. We have a couple that came to us a couple years ago. They were referred to us. And when they came to us, the gentleman, okay, so it was like, be quiet, wife, I take care of the investments. And she wasn't interested anyway. But it was like, be quiet, wife, I take care of the investments. This is 1950. So that's his wife's just off doing wife stuff in his 1950s America. And the only problem is, it's the 2020s. Right. And she didn't know what he was doing. And turns out he didn't know what he was doing. But grief, I'm glad we got him before something bad happened. They came to us with their investment statements, and here's the problem. He's a smart guy. Usually dumb people don't get in trouble. I mean, it could happen, but we have, I don't know. We have some clients that are of average intelligence or average, intelligence is information and smarts is more like what you're born with. We have clients of average smarts or even below average smarts, above average smarts, kind of in that average-ish smarts. You're a baseball pitcher, Matt. The guys that are batting 450 to 550, well, that's actually pretty good. I'm not making any sense right now. So there's people.
I know where you're going with this.
What I'm saying. There's kind of people at the median, right? And not even the average, the median. And it's just kind of, average smarts. The average smarts people usually don't do really dumb things. It can happen, I know. But what I have noticed, Matt, what I've always noticed is the smarter people are, the more wilder nonsense. I was going to say something else. I was going to say Bravo Sierra, for those of you who don't, phonetics. The smarter people are, the more BS they might try to pull. And the problem with that, or the challenge with that is if for your plan to work, everything has to go right, it's a bad plan. So, okay, so this couple came to us. The wife is in the proverbial kitchen. Not really. I think she might cook. She might not. I'm not really sure how they consume food. But the wife is told to go do the wife stuff, and she doesn't really care for investing anyway. And he's being Mr. Man, like, well, look how smart I am. I'm going to beat the market. So I don't know. You never met these. You've known these folks now, Matt, now that they're reformed. But you didn't know them when they came on. Might you guess what they were doing? I think I may have told you this before.
I don't know. There's tons of different ways they could be, and I just thinking about it, I have no idea where they would have been to start. So
Mr. Man, what Mr. Man was doing is he had their whole life savings. And how many stocks, Matt?
Don't tell me he had them in one.
No, not that bad.
Okay.
How many stocks?
Let's say 5.
3.
Wow. Okay.
So 3 stocks. This is just too ridiculous. 3 stocks, Matt, but broadly diversified? How do you broadly diversify 3 stocks?
I don't know. I need an explanation on that one.
Were they in like 3 different sectors?
Broadly diversified 3 stocks. Jeez.
How do you diversify 3 stocks? So what he did is he had their whole life savings in 3 tech stocks.
Oh.
And the higher they fly, the further they fall. So Thank goodness. And at first he was telling us how smart he was. And that's the problem though. I can't tell him he's stupid because he's not stupid. Mm-hmm. I can tell him he's stupid if I wanted to tell him he was stupid because he wasn't stupid. The problem was he's smart. And that's what I mean. I mean, we do have people that are less bright than others that do get in trouble a different way, but the smart people can over-engineer stuff and come up with all of the logical reasons why they must be right.
I was going to say, I think that's where it comes from is they know that they're smart. They have the thought process to do it. So they read one thing and that's like they start building up that logic to, oh, I've got the answer now.
You know, and it can even be more than one thing. It can be that confirmation bias. And you need somebody to call you on your Bravo Sierra, on your BS, because you can go find the information that will tell you you're right. Or, you know, you ever watch, I'm just going to make something up. Let's say, Matt, let's say that you watched a cat video on YouTube. And I have figured out, or I can't remember if I read it or I was told it and I noticed it. If you complete a YouTube video all the way to the end, it doesn't matter if you subscribe or like it. That doesn't really matter. But if you search a topic, you watch a video on that topic, and you watch it all the way to the end, you're going to get more of that content creator and more of that topic. So I think I watched, I looked up something about ice hockey, like how to do something or something, whatever, one maneuver or another, how to best do this or how to best do that. And it was like a 5-minute video even. And you watch it to its completion, it shows you another one. And if you watch, maybe that's a 10-minute or 20-minute one on a different topic within ice hockey techniques or practices or whatever. You watch that, a complete video of that. Well, it's going to keep showing you more ice hockey and more ice hockey and more ice hockey. And you're like, wow, is there anything else on YouTube other than ice hockey?
It's just feeding you what you want to eat.
It's telling you what you want to hear.
Exactly.
Yeah. Here's your his favorite dinner. Like we get food delivered during the week. Our office is in Chicago, and there's a kind of a fast casual restaurant, Portillo's, created by Dick Portillo back in, I think he started in the 60s, can't remember. And so the quickest, easiest thing to eat from Portillo's is the chicken sandwich, and it is delicious. It's like a broiled chicken breast sandwich. Very tender, very tasty, fast to eat, no muss, no fuss. And they'll deliver it right to the office. So Nicole will say, what do you guys want for lunch today? And a couple days a week, I'm like, how about Portillo's chicken sandwich? She's like, you guys just had that. I know, but it's delicious and it's quick and easy to eat.
I think the biggest thing is how quick and easy it is to eat.
Yeah. Other food is a little messier and stuff and whatever.
Yeah.
Yeah. So anyway, as I'm getting hungry. So if I want to watch ice hockey videos and I watch one ice hockey video, it's going to show me one more ice hockey videos. Or what if you went, here's the thing people are doing too. They'll go onto YouTube and use it like a search engine while we're talking about YouTube. And they'll say, should I use tech stocks? And actually, this gentleman wasn't even thinking, because he's about 70 now, I want to say, and he was like 68 a couple years ago, right? That's how it works. But say he was going to say, how can I beat the market? That's a really dangerous question to ask the internet.
Well, and I think what's scary is there's a few people out there who probably think they have the answer to do it, and it could just be some, Joe Schmo.
If your name's Joe Schmo, click down below, tuckerretirement.com, get on our phone calendar, 15 minutes for free in the coming week for our financial planners at tuckerretirement.com. Matt, we'll get their questions answered, Dan.
Their answers questioned.
Yeah, we nailed it there. Sometimes I get that turned around and get confused. So there's some really dangerous things you could ask YouTube or the interwebs. Okay, so one of the most dangerous questions you can ask is, interwebs, how can I beat the stock market? So, Matt, if you're to ask the interwebs how to beat the stock market, it's going to tell you something like what?
You'll see a few things that would be like, oh, there's this hot stock. It's expected to go up X amount % this year. Or, hey, I've done this in the past, and here's what I think will happen. But there may not be any factual evidence behind that.
So we're not recommending that you buy or sell any security. We're just spitballing what could go wrong. So don't take this conversation and treat it as advice, because it's not advice. It's a silly podcast. If you want silly advice, or actually better advice, tuckerretirement.com, click down below so we can get a complete conversation and get the lay of the land with you. So this is not a one-size-fits-all endeavor. So, Matt, if I ask the interwebs, how can I beat the stock market? What I was thinking is the interwebs is likely to say, oh, Scott, you want to beat the stock market, like the S&P 500. Say you want to beat the S&P 500. Well, then, Scott, what you ought to do is you ought to invest in these highly speculative growth stocks, and they're going to be tech stocks on the NASDAQ, and then it's going to get crazy, and it's going to tell you, and you say, oh, well, recommend 3 stocks, ChatGPT, and it's going to say, oh, Scott, well, you ought to invest in NVIDIA. I don't know. I can't even think of what else what it would say now, and what it would currently say. It keeps changing what it's going to recommend. And so what people fail to realize, I guess, to close this loop, is what people fail to realize is to beat the stock market, you have to take greater risk than the stock market, typically.
Right.
It's unusual. You're going to take less risk than the U.S. stock market and beat it. And so if you're going to beat the stock market, what people overlook is that you're likely to greatly underperform the stock market at the same time. So as markets go up, stocks tend to go up together. And so there might be a tech stock might go up a little faster or sharper, and the railroad might be more boring and all this kind of thing. But when there's a recession, they will tend to both fall, but the tech stock might fall a lot further because the goods still need to be moved on the railroad, but folks have their emotional quasi-intellectual bubble burst about the AI. They go, oh, it was all a scam, and they sell that off, So when we go into recession, folks buy Coca-Cola and they buy the railroad. They buy all the Warren Buffett stuff.
Right.
They buy the steel foundry. They buy a bunch of like tangible things. They buy like the toilet paper company and the detergent company, and
it's like the things you can't live without.
Yeah. So in a recession, what will be out of favor will be all the high flying stuff. And so just a thing to keep in mind that a lot of folks, I think, miss all the time is I heard this on the radio the other day. It was a financial radio show / podcast. And they're talking about how certain mutual funds beat the stock market. Well, mutual funds or even your advisor, they only really beat the stock market if they take greater risk. What we try to do, we work primarily with people who are about to retire or who are newly retired. So when people start working with us, they're like 55 years old to 70 years of age. And then, of course, they scoot along and get much more experience than that. Our most experienced client, I want to think she's 102 right now. Time flies. And so we've got to be really careful not to lose your money as you get close to retirement or you're newly retired. And newly retired can be like in the last 10 years, okay? But if we screw this up, because we can't invest your money like it's ours. So Matt's not even quite 30 yet. I know he seems like he has the wisdom of a 50-year-old, but he's not even quite 30 yet. And he's got a good head on his shoulders and his feet are on the ground. But he could afford to mess up his investments, 3 times, maybe more. Those big 2008 crashes and recoveries. You could live through like 3 of those and not break a sweat. But somebody who's going to retire next month or who retired 5 years ago, if they lose half their money and it takes years to come back and they're having to spend out of that while they're waiting, that's not really going to work really well.
No, there was just a gentleman I was talking with the other day, and he was saying how it was almost verbatim what you had just said. He's like, I don't have the time to just screw this up.
Yeah.
And he's like, because I'm not going back to work.
Yeah.
And like you said, unnecessary risk is unnecessary.
It's hard to tell your boss to take this job and shove it and then show up on Monday morning and say, you know what? Did I say, was that George Costanza and one of the Seinfelds? He's like, oh yeah, George told the boss to take the job and shove it and whatever, and he quit. And this is what I think of your company and all this stuff. And then something or other happened. I think it was the job he had lined up fell through or something. So then George Costanza, he shows up to the company Christmas party from the guy that he just told to shove it. And he shows up and it's like an open bar, and he just sneaks in there. And he goes up to get a drink, and the guy goes, Costanza, is that you? And he's like, what? And he's like, didn't you just tell me to stick it? And he's like, oh, you thought I was serious? I'm
joking.
I was joking. Oh, come on. It's Christmas time, whatever it was. And so it's hard to unquit your job. It's actually fairly easy to find a job. It's pretty easy to not get fired from a job. You just do your job. But if you tell your boss, like, take this job and shove it, and here's what I think about you, and then you just show up at the Christmas party and you're like, hey, how's it going? How about those Mets?
Might be a little bit of an awkward conversation there.
I was going to say, how about those Mets? But I think actually Costanza in the show, they were Yankees fans, I believe.
Can't remember off the top of my
Well,
head.
remember when George Costanza, he worked for George Steinbrenner? He worked at Yankee Stadium, the old Yankee Stadium.
Okay.
You got to go back and watch. I know because
Yeah.
Seinfeld's an old show now. Yeah, I've got shows older than you, Matt.
I know.
I'm thinking about when Seinfeld was really a big deal. Mid '90s, it was a really hot snot back then. And then in mid '90s, that makes me sound like a dinosaur. That was 30 years ago. That's something else. It's getting depressing, Matt. Pretty soon I'm gonna be retiring. I'm 53. I don't know what I would do. I don't know. I'm not a good sit still person. I tell you that much. I have to come up with a system of hobbies.
Right. Like you need something to do to keep you going.
Need a lot of hobbies.
Yeah.
A lot of hobbies. I think I play hockey. I play in a men's league one night a week, and then there's these insane like hockey practices. There's a coach, Coach Kevin Delaney, DelaneyHockey.com. He's a coach for the Chicago Blackhawks. Their next level below NHL is the Rockford Ice Hogs. So he's a skills coach for them. And then the Chicagoland area, he does throughout the week, he does these kind of all ages practices, or sometimes they divvy up like the mites. The mites are little kids, and they skate by themselves. They're just learning to play hockey. The Adams and the mites. But then like squirt and above all the way to, like 60-year-olds or whatever, that's the kind of all ages practice, or squirt and above practice. And so those are really a great workout because you get 60 minutes straight ice time, like no breaks. It's pretty exhausting. And I'll do that Saturday morning, Sunday morning. I'll do it on a Thursday morning, and then I'll have like a Monday night hockey game. So I could do that in retirement. That does kind of keep your fitness together and kind of wear you out a little bit, give you something to do. But I think what I would do is, if I was retired, is I'd get back into coaching youth hockey. Because when I first got out of the Navy in '96, I was 23, and I coached Bantams, which are 9th and 10th graders. I did that for a season, but that is like having kids in hockey. And I was like trying to go to work and go to school and all that stuff. I was going to college and working full time, and then coaching a Bantam hockey team. I was coaching the defense, and these two dads were coaching the offense mostly. And but I was like, man, this is exhausting. This is like having like a kid in hockey.
Yeah.
And imagine there's people that have like 2 and 3 kids in hockey. That's insane.
Yeah.
You just like spend all your time driving kids to ice rinks. Well, anyway, if you'd like to get on our phone calendar, 15 minutes for free in the coming week with one of our financial planners, just go to tuckerretirement.com or click down below. You'll see our phone calendar. We'll get it all sorted out. And you've wasted yet another perfectly good 22 minutes listening to the ramblings of a short, bald man. I'm Scott Tucker, Retirement Decoded podcast. My trusty sidekick, as most of the time, is Associate Advisor
Matt Marabella.
There he is with the robot cameras. You can see the video podcast at tuckeryoutube.com. We'll talk to you on the next podcast.